Imagine a company that's not just surviving, but thriving amidst the global shift towards healthier lifestyles. A company that's not just adapting, but leading the charge in its industry. Welcome to the world of Philip Morris International. In the smoke-filled battlefield of the tobacco industry, Philip Morris International stands tall, wielding its reduced-risk weapon, the IQOS brand. While others struggle to keep pace, Philip Morris is sprinting ahead, outperforming competitors like Altria, British American Tobacco, and Japan Tobacco in the race of revenue growth. It's not just about survival for Philip Morris, it's about dominance. But don't be mistaken, this isn't a reckless pursuit of power. It's a calculated strategy, a vision of a smoke-free future where reduced-risk products rule. This vision isn't a distant dream, it's a tangible goal. By the year 2030, Philip Morris aims to generate at least half of its revenue from reduced-risk products. A bold move? Absolutely. But for Philip Morris, it's simply business as usual. And the numbers? They're just as impressive. With a projected revenue growth of 6 to 8% and operating income growth of 8 to 10% for the next 3 years, Philip Morris is not just making promises, it's delivering results. Earnings per share are expected to grow at a rate of 9 to 11% per year, potentially reaching $8 by 2026. But what do these numbers mean for you? It's simple. With the potential to reach $8 earnings per share by 2026, Philip Morris is not just a powerhouse, but a potential goldmine for investors. Philip Morris is not just sitting on its laurels, it's making waves, making moves, and making headlines. In the world of business, a company's success hinges on its ability to adapt, innovate, and make strategic decisions. Philip Morris, a leading tobacco company, exemplifies this approach with its recent bold moves and strategic acquisitions. Let's start with the company's bid to acquire Swedish Match, a major player in the market for cigarette alternatives. This move, currently under consideration, would not only bolster Philip Morris's portfolio, but also underscore its commitment to reduced-risk products. Interestingly, Philip Morris is contemplating lowering the acceptance threshold for this bid. Rather than requiring a 90% shareholder approval, the company may opt for a majority stake, gradually acquiring the remaining shares. This strategy reflects Philip Morris's willingness to adapt and negotiate to achieve its goals. But that's not the only headline Philip Morris is making. The company recently acquired Vectura, a British drug maker, for a whopping $1.44 billion. This acquisition, which outbid a previous proposal by investment firm Carlyle Group, gives Philip Morris access to Vectura's respiratory ailment treatments and inhaling device technology. It's a clear signal that Philip Morris is not just a tobacco company, it's a company investing heavily in the future of health and wellness. These acquisitions align with Philip Morris's broader goal of generating more revenue from smoke-free products. The company has set a target to generate at least 50% of its revenue from these products, and 2/3 of its overall revenue by 2030. With its smoke-free revenues already making up more than 35% of total revenues, the company is well on its way to achieving this goal. In the game of chess, Philip Morris is playing for keeps, positioning its pieces for a checkmate in the industry. The company's bold moves and strategic acquisitions signal a clear direction towards a healthier future, a future where reduced-risk products take center stage. As we continue to watch this space, one thing is certain: Philip Morris is not just making moves, it's making waves. With all these factors in play, the question stands: is Philip Morris a good investment? Let's take a moment to dissect this. Philip Morris, a leading tobacco company, has been successful in the reduced-risk product category, particularly with its IQOS brand. This has led to robust growth in sales volumes, revenues, and profits, even outperforming competitors such as Altria, British American Tobacco, and Japan Tobacco. The company's future also looks promising, with forecasts of revenue growth of 6 to 8% and operating income growth of 8 to 10% over the next 3 years. The earnings per share are expected to grow at a rate of 9 to 11% per year. Even with conservative estimates, Philip Morris's earnings per share could reach $8 by 2026. Now that's a potential 29% upside in the stock price. And let's not forget the attractive dividend yield of 5.5% that investors would receive. But as always, there are two sides to every coin. Philip Morris is considering acquiring Swedish Match, a move that has divided shareholders. Some, like activist investor Elliott Investment Management, oppose the buyout deal. Others, like Wellington Management, Capital Group and BlackRock, are major shareholders in Swedish Match, and their stance could significantly impact the outcome. The deal requires 90% shareholder approval to proceed under Swedish law, and at this point, it's unclear if that threshold will be met. This uncertainty can impact the company's future and, consequently, the decision of whether to buy or sell Philip Morris stocks. The final decision, of course, lies in your hands. But one thing is clear: Philip Morris is a formidable player in its industry, and it's not going anywhere anytime soon. Before we part ways, remember this: knowledge is power, and you've just been empowered. We've explored the financial powerhouse that is Philip Morris, the audacious acquisitions they've made, and the question of whether to buy or sell this compelling stock. With strong growth in sales volumes, revenues and profits, and an ambitious focus on reduced-risk products, Philip Morris is a stock that certainly demands attention. So weigh your options, make your move, and don't forget to hit that subscribe button for more insightful content. Until next time, invest wisely.